Financial Literacy for Beginners, a comprehensive guide. Financial literacy is all about effectively managing your finances, building wealth, and securing your financial future. This involves learning basic concepts like budgeting, saving, investing, and understanding credit for beginners. This guide will help you start your journey to becoming financially literate. Here are the steps to follow. 1. Budgeting, the foundation of financial literacy. Budgeting is the process of planning your income and expenses to manage your money effectively. It helps you ensure you have enough for necessities, savings, and even some wants without falling into debt. Steps to create a budget. Calculate your income. List all sources of income, including salary, side jobs, or passive income. Track expenses. For a month or two, track every dollar you spend. Categorize your expenses into fixed expenses like rent and utilities, and variable expenses like groceries and entertainment. Set spending limits. Based on your tracking, set realistic spending limits in each category. The 50-30-20 rule. Adjust to personal preference. 50% for necessities, rent, food, utilities. 30% for wants, entertainment, dining out. 20% for savings and debt repayment. Review. Regularly, your budget isn't static. Adjust it as your financial situation changes. 2. Saving. Building your financial cushion. Saving is setting aside money for future needs and goals. It provides security in case of emergencies and helps you achieve larger financial goals. Key concepts. In saving, emergency fund. Aim to save 3 to 6 months of living expenses for emergencies like medical issues, job loss, environmental changes, etc. Automate savings. Set up automatic transfers from your checking account to a savings account to make saving a habit. High-interest savings accounts. Choose accounts with better interest rates to maximize your savings. Short-term versus long-term savings goals. Short-term, vacations, investments, or an emergency fund. Long-term, retirement, a home, or children's education. 3. Investing. Growing your wealth. Investing involves putting your money to work in assets like stocks, real estate or REITs, or newer asset classes like crypto and blockchain technology to grow your wealth over time. It carries risk, but has the potential for higher returns than savings accounts. Investment basics. Stocks. Buying shares of a company. Stocks can provide higher returns, but they're also more volatile. Bonds. Loans to governments or companies, usually less risky than stocks, but with lower returns. Mutual funds and ETFs. Pooled funds where money from many investors is invested in a diversified portfolio. They are safer for beginners since they spread the risk. Risk tolerance. Assess how much risk you're comfortable with based on your financial goals, age, and income. Diversification. Don't put all your eggs in one basket. Spread your investments across various asset types to reduce risk. Start early and consistently. The earlier you start investing, the more time your money has to grow, thanks to compound interest. 4. Debt management. Handling borrowed money responsibly. Not all debt is bad, but managing it effectively is key to financial health. There is a difference between good debt, for example, a mortgage, student loans, and bad debt, for example, high-interest credit card debt. Tips for managing debt. Understand interest rates. High-interest debt like credit card debt should be paid off first since it costs more over time. Minimum payments. Always pay at least the minimum on all debts, but focus extra payments on the debt with the highest interest rate. Debt repayment strategies. Snowball method. Pay off the smallest debt first, then move on to the next. Avalanche method. Focus on paying the highest interest debt first, saving money on interest. Avoid unnecessary debt. Limit the use of credit cards for purchases you can't afford to pay off at the end of the month. 5. Credit scores and credit reports. Building and maintaining good credit. Your credit score is a numerical representation of your credit worthiness, and it affects your ability to borrow money and the interest rates you receive. How to build good credit. Pay bills on time. Payment history accounts for 35% of your credit score. Keep credit utilization low. Try to use less than 30% of your available credit limit. Avoid opening too many credit accounts at once. This can lower your score. Monitor your credit report. Regularly check your credit report for accuracy. In Canada and the US, you're entitled to a free credit report annually from credit bureaus like Equifax and TransUnion. 6. Taxes. Understanding your obligations. Understanding taxes is crucial for financial literacy. It affects how much of your income you keep and how to maximize your deductions. Tax basics. Types of taxes. Income tax, property tax, and sales tax are the most common for individuals. Tax brackets. Your income level determines which tax bracket you fall into. Tax deductions and credits. Learn about deductions, for example, retirement contributions, student loan interest, and credits, for example, for education or dependents, to reduce your tax burden. Filing taxes. Ensure you file on time and accurately, either by using tax software or consulting with an accountant if needed. 7. Retirement planning. Preparing for the future. Retirement may seem far away, but planning early helps you benefit from compound growth and ensures financial security in your later years. Retirement ideas. RRSP 401k. Employer-sponsored retirement plans with tax benefits. Individual retirement accounts, IRAs, or TFSAs. Canada. Tax-advantaged accounts you can contribute to on your own. Employer match. If your employer offers to match retirement contributions, take full advantage of it. This is free money. Estimate your retirement needs. Start thinking about how much you'll need to live on during retirement and adjust your savings rate accordingly. Long-term investments. Properties or investments you saved for your retirement plans. 8. Insurance. Protecting your assets and income. Insurance is essential for protecting yourself financially against risks you can't predict, like accidents, health issues, or natural disasters. Types of insurance. Health insurance covers medical expenses. Life insurance provides financial support to your dependents if you pass away. Disability insurance protects your income if you're unable to work due to illness or injury. Home and auto insurance protects your property and assets. 9. Financial goals. Setting and achieving them. Setting financial goals is key to staying motivated and on track. Your goals should be SMART, specific, measurable, achievable, relevant, and time-bound. Examples of financial goals. Short-term. Save $500 for an emergency fund within 6 months. Medium-term. Pay off $10,000 in student loans over the next 3 years. Long-term. Save $1 million for retirement by age 65. 10. Continual learning. Keeping up with financial knowledge. Financial literacy is an ongoing process. As your financial situation changes and grows more complex, continue learning. Summary. 1. Budget your income and expenses. 2. Save for emergencies and long-term goals. 3. Invest wisely to grow your wealth. 4. Manage debt effectively and avoid bad debt. 5. Build a strong credit score. 6. Understand and manage taxes. 7. Plan for retirement early. 8. Protect yourself with insurance. 9. Set and pursue financial goals. 10. Keep learning to stay financially informed. Mastering these basics of financial literacy will set you on the path toward financial independence and stability.